Making a ton of money in the stock market doesn't take a person with a rocket science degree, but I bet the salary helps. It literally takes two things: time and following a simple strategy. That strategy is called dollar cost averaging. It's allowed me to build over $500,000 in my portfolio by the age of 39. In this video, I'll go over the three simple steps of how I put together this strategy to win big. My name is Paulo Azevedo. I'm a high school dropout who has failed many times until I found success in running my own business. I own multiple businesses like a seven-figure Amazon business, credit repair, and a funding business. I help people like yourself level up in business and personal finances so you don't make the same mistakes I did. It's not about being the smartest that gets you ahead. It's about taking consistent action day after day, week after week. What's the point of being a library and having all this knowledge, but not putting it into practice? I'm the first person in my family that invested in the stock market at the young age of 27, and I started the more expensive way with many hard lessons. I day traded stocks, so I would buy stocks here and there that were, I think, hot at the time. Back then, only a few $100s worth, and I would watch the stocks go up and down, and I would try to time the market so I would buy low and sell high. Let me tell you, it didn't work out. It was constant work. I would lose big. I would win big at random times. There was no true strategy in place. I didn't have a coach. And I ended up losing quite a bit of money. So I gave up on doing it. The emotional turmoil was just too much, and losing money sucked too. I wanted to do well in buying stocks, and I knew other people were doing well too. So why couldn't I? Then I read a book called I Will Teach You How to Be Rich by Ramit Sethi. And in that book, he talked about dollar cost averaging. Now, this strategy called dollar cost averaging is very simple. You just basically buy a fixed amount and a fixed interval. It doesn't matter what the price is, whether it goes up or goes down, you're buying it. So, an example of this would be if you buy $50 worth of VOO stock every 2 weeks, this means you're going to be buying it when the price of that stock, whatever it is. It could be $80 or $82, or it could be $78. You're always going to be buying it. So whether it's a bear market or a bull market, you're always buying at those intervals at those set amounts. And this was freeing to me at the time because I actually didn't need to be behind a computer and like watching the graphs go up and down. I could just set it and forget it. It will be automatic every Friday or whatever day I set it up to be, and it would just buy the stocks for me. So I would buy ETFs because they themselves spread the risk by being compromised of many different stocks, many different companies or categories of these companies in what they operate in. So depending on which one I know you pick, you'll have a wider spread of companies or less. By far, the most common ones that do very well are the ETFs, the exchange traded funds. That's what they stand for. That are based on the Standard and Poor 500, the S&P 500. You might have heard that term everywhere. The S&P 500 has been around for over 50 years, and it's really just an index tracker of the 500 largest companies in the New York Stock Exchange. And on average, it grows between 8 and 12% per year. So most investors like that because the returns are pretty good. They're better than inflation. They're better than a high yield savings account. And so that's what I do. I buy these index funds that tracks primarily that index. Now, I started back in 2013 when I got my first job out of college, 27, making 50K a year. And I would buy VOO and VTI. And I was still hesitant at the time, right? Who wouldn't be? Because this new strategy wasn't proven to me, right? Like, obviously, anytime you're doing something uncomfortable, something new, it's going to be uncomfortable. It's going to be like, oh, what ifs? What if this and the fear and this and that? But like, you really don't know until you try. And that's what I did. So I started buying it. And I would buy $50 a week at the time. And my company would match me a certain amount because it was my 401k. And that money would slowly grow and fall until over time, over a few years, is really when it was really obvious that the money started to creep up higher and higher more often than it was dropping. So it was really working the strategy of dollar cost averaging. So fast forward to COVID in 2020 and recently in 2025 with Trump putting these tariffs on basically everything, everybody, the market took big dips. And I knew from my experience from 2013 till 2020 that there were constant dips in the market. And those were great opportunities to buy more stock, especially if you had more money. The S&P 500 took a 10 to 20% dip within like a week or a few weeks. So like over the years, it's been climbing and climbing steadily. I knew it was going to come back. So those are prime opportunities to buy. When everybody else is selling, that's when you really should buy. That's not 100% true across the board, but for the S&P 500 has been true for me. So I bought more as much as I could during those dips in 2020 and now with Trump in 2025 and the market came racing back within months. And I've made much bigger returns because I bought in the dip and it's added to my total like 8 to 12%. Now I'm actually higher. So I'm very happy with these returns over the past few years. I do want to say that the first $100,000 in your 401k or in your brokerage account is the hardest to grow because you actually don't see much in returns until like you hit that point. What I mean by that is it doesn't move the needle to get a return of even 8% on $10,000. It's not a big return, you're thinking like 800 bucks. It's not going to change somebody's life in a year. I've been there. But I do know that 10% of returns in $100,000 in your brokerage account, that's a $10,000 of profit for doing nothing. Once the money's there, it's working for you. Now, what about $500,000? That's almost $50,000 at 10% in returns. That's a whole US average salary in just 1 year in the market by you doing zero actual work. The compound interest really is powerful. The longer you stay in the market, the more money you will make. You start investing as young as possible. If you can invest at 18, great. The best time to start is now. Once you start, get to 100,000 as fast as possible. If you start investing at age 18, when you retire at age 65, every dollar you put in at the age of 18 will net you using the average 8% return per year of $42. It was going to be the total amount at the end. So $1 will turn into $42. That's the power of compounding every year. 8% every year after, whatever that is, 40 years, 40 something years, that's how much money you'll have. You'll beat inflation for sure. So that so that's why investing at a younger age is more powerful. The more money you can load up at the beginning, especially at a young age, the more powerful compounding interest is. So let's get into the simple 3-step strategy to get yourself situated into investing with very little work. Step 1 is you want to pick an index. My personal opinion, I've had great success with VOO. I think it's a great fund. You can also go with VTI, SPY, and they all track the S&P 500. And the S&P 500 itself, the companies, sometimes a company does great and they jump into the top 500 and some companies don't do as good and they drop down. So uh, what you own will change, right? You own the ETF, but that ETF owns bits and pieces of other stocks from these different companies like Apple, Microsoft, the big companies of the US. Any index fund that tracks S&P 500 will do really well. So just pick one of these to start. Focus on the ones that have the lowest yearly fees. In my opinion, I think VOO has the lowest one. And there is a fee, like I think it's like 0.5% of the fund amount that you have. That's the fee per year because these funds are actively managed by other people. So that's their fee to buy this index fund. Step 2, you want to automate this entire process of buying. You can set up weekly, bi-weekly, certain dates, monthly transfers from your bank to the brokerage account. You set it up in the brokerage account and it pulls from your bank account. I personally like using Vanguard and Charles Schwab for my brokerage accounts, but they all operate the same way these days. The apps are great. I have an automatic transfer of about $800 a week into my wife's and my brokerages. And then the brokerage account buys $800 worth of those stocks and just adds it to the total. It doesn't matter what is happening in the world, who was elected, I'm buying. And this is really the most important step to take, right? It's automating this process. You want to make sure it just gets done. You don't need to think about it per week. You can start low if you want to, just make sure you always have that money available for you, right? You can pause it if you want to. There's no fees to maintain these accounts. These brokerages are really, really easy to use these days. And the third step is really just stop checking your balance. It's so easy to be like, open it up. It's like, how much did I make today? And this and that. And really, I've lost so much time looking over these stocks because when I was day trading And when I wanted to start, doing dollar cost averaging, it was super exciting but it didn't help much. It didn't move the needle for me. I was just looking just to like get that dopamine hit. I'm not saying don't ever check it, but you don't need to be checking it daily. Check it monthly, if anything, just make sure that it's working and just never sell. Even though it might drop like 10, 20% in one time, don't sell. That's the biggest tip that I can give you. Over the last 10 years, this exact process, this 3-step process that I set up, automatically has made me a ton of money. And if I don't add a single extra dollar to what I have now in my brokerages, I'm 39 years old, and at 8% return per year when I retire at 65, I'll have $4.4 million in my account. Right now, I have a little over 500,000. The key is to get started. I started when I was making about $50,000 a year, but you can start with way less. Make a choice to do so. You won't regret it. The only regret you will have is not starting earlier. Don't make the same mistakes I did, guys, with day trading, trying to time the market. It really hindered my growth. I wish I started buying stocks earlier using dollar cost averaging. I would have had a lot more money now. If you're struggling to get funding because of poor credit due to negatives like late payments, collections, and repos, and eventually you want to get business funding with high limits, you can click on the link below to set up a time with one of our credit advisors for free.